since this time of year, the end of the month, the end of December, is more about looking ahead, one of the things that I focus on, not only in my own trading, but also in the things that I write, like at the Daily Forex Trading Edge, or if you follow me on Twitter or on Facebook, I'll talk about a little bit more strategy-oriented ideas so you can apply that come the new year. I'll also talk about where I think the current trend is and where that could carry us into next year. What's really funny to me about this time of year is that it's inevitably about how a lot of analysts and some traders, but mostly analysts, will go out there and start projecting levels for the coming year. And I'll be frank, that's not my job. My job isn't to predict anything. My job is to find those levels at which there could be some sort of reaction in the market. That is my job as a trader, because I hardly know where things are going to be next week or even tomorrow, forget 6 months down the line or next year. And those are the kind of oddball questions you're going to see paraded about on a lot of the financial television shows. I have no interest in doing that because everything moves as a series of hurdles. I think the Euro-US dollar, which you should have on your screen right now, is a perfect example of this idea that everything moves as a series of hurdles. And the reason I say that, and the logic behind it, is if I were looking at the euro going back to about this time here, and around this time over at the Daily Forex Trading Edge, I was writing about the behavior in the euro, which was a bounce within the context of a fairly fresh and renewed downtrend. Now, the whole reason behind looking at that bounce as an opportunity to short, as I outlined in that update over at the DFTE, was because looking at the environment, looking at the green grab candles that we once had, segueing into blue, and then dominated by the red, which also accompanied a more 4 to 6 o'clock angle of my 34 EMA wave, to put that move higher in context, it was a correction. It was a retracement of the downtrend. And if that was the case, which I felt it to be, as I confirmed it with the different tools, the visual tools that I use, what I had to then do is consider whether or not I was comfortable shorting this particular time frame of this particular pair. Now, I say this particular time frame because strategies are time frame specific, because oftentimes the individual trends on the time frames are specific as well. If you went back and looked at a 5 or 15-minute chart, even a 30-minute chart during this period of time, it's likely what you saw was some sort of move higher on those short-term intraday time frames. And if you wanted to get long and take advantage of that move higher back during this period of time, okay, during this correction here, which essentially covered the last week of November into the first week of December, you would notice the strength on the short-term intraday time frames contrasted by the correction on the longer-term time frame. So that's one of the main reasons I want you to understand why we want to differentiate between short-term time frames and long-term time frames and even the individual time frames. Because when you are looking at the grab candles, when you are looking at the 34 EMA wave, it is imperative that you look at them individually so that you understand that view of the psychology through that time frame. Now, the daily is the most psychologically significant because it's the one that I believe and have noticed over 20 years of trading is the one that is most well followed, the one that's most discussed, the one that most people refer to when they are describing the behavior, the bigger picture behavior of any pair, of any market, really of any stock. So the psychology, or what I call the directional bias that I take from the daily, is the one that I'm going to use to determine how and in which direction I can trade the shorter term intraday time frames, even the longer term like the 60 and 240. So here's how it would work on the euro US dollar. On the daily chart, I'm looking for a short, and that's exactly what I went ahead and set up. On the 60 and 240-minute charts, because of the bearish sentiment and momentum and bearish trend, on the 60 and 240, I would have to follow that bearishness. I would have to look for a short or stay flat in terms of setups on those time frames. However, if I wanted to take advantage at that moment, last week of November, first week of December, the movement higher, and take a counter trend trade, which would be what? A counter trend would be a buy, right? If I wanted to get long on the euro US dollar, which was counter to the daily charts directional bias, I could only do so on the 5, 15, and 30. So the directional bias isn't here to tell me that I can't get long this pair. It simply will tell me if I'm going to take a counter trend trade, I will only expect bullish sentiment, bullish momentum, that bullish organization to last for a very short amount of time. Because it's my opinion that when we hit one of these resistance levels, we don't know which one, we might have a number of resistance levels we're watching. That's why they're all decision levels. We're waiting for the reaction, which is the sellers to step back in and pressure the market lower. That's the idea behind making sure that if I am trading counter trend, I keep very nimble, I keep very short term. So moving on from there, we see what happened. Now, the scope of the move, this drop, that's something I don't project. That's something I would never come out and say that a certain pair is going to be at a certain price level in a certain amount of time. There are factors that could increase it. Obviously, different fundamental factors, the different meetings. There's a number of things that we can look at that may increase the chance of an acceleration lower, but I don't ever want to expect a particular kind of reaction. Again, my job is not to fortune tell. That's the wonderful thing about being back here in my trading office and not necessarily having to be extremely public about where I think the market's going. You know, I don't think a lot of traders who go on a lot of different financial programs even necessarily want to do it, but that's what they demand of them. That's what the news is. Well, us traders know differently, right? Everything is a series of smaller tests. In other words, this swing short was contingent on, for me, selling pressure below the 20-period simple moving average, which was this gray silver line. Selling pressure within the area of the 34 EMA wave, which is that area starting at the red and extending all the way up to these green dashed lines. It was maintaining a red grab candle. In other words, the organization of that bearish sentiment and momentum. It was keeping that 4 to 6 o'clock, therefore, intact, that angle. If the selling pressure continued here, and I could get a series of lower highs, the next test then is, can I get a series of lower lows? And we did get that. Not only did we get the lower highs, we got the lower lows. And that's exactly what we want to see. Because that tells me the sentiment and momentum is pressuring the bulls, and eventually we will chip away at a support level at which the bulls either, one, aren't at, or two, aren't willing to support. And then this is the kind of price action we'll get. Now, my short here did not rely on getting to a new low. In other words, when I entered short here, my initial profit targets, or my targets where I felt buying support could come in, therefore it would be logical for me to take a little bit of my position off the table or watch very closely as we tested those levels. I'd rather do the former, which is be proactive. I have multiple lots up in this area. If you're not trading with multiple lots, my advice is to go down to a mini or micro so you can. Remember, one full-size lot offers you no flexibility, while 10 minis offers you the same control of the pair, but offers you 10 pieces. So at 10 minis here, if that's what you're comfortable with, that's one full-size lot, you can exit 2 to 4 contracts here. You could exit 2 to 4 contracts here, and you'd have a remainder, not your total position size, but you'd have a remainder that you could take south of this low here in case prices do make a lower low. But don't demand within your trading plan, within your risk-reward calculations, that a market make a lower low or a higher high for that matter in an uptrend for you to see your risk-reward ratio balance out. I would have been absolutely fine with an entry at the 34 EMA low or the 20-period SMA to the top line of the wave up here, the 34-period EMA high, with this low or this low. That would have made my risk-reward ratio at a 1-to-1 or better. So I took a little bit off here at that low because that very well could have been a point at which the bulls were willing to step up. They had before. I can't ignore it. Then I took a little bit again, and what remainder, what was left, was able to benefit from that acceleration through these two lows. Okay, so it's not about keeping your full position size through the whole move. Not for me, it isn't. I want to be proactive about realizing that once my trade is going in my favor, it's my job as a trader to realize a portion of what I have then profited from. I don't have to take it all off the table, but in order to maximize the position I'm in, for me, it's about minimizing the risk. I know that sounds funny, but to me, it's all about managing risk. It's all about minimizing risk as I can. So the moment I reach a profit target and I can realize and acknowledge that the trade is now a quote-unquote winner, I will then take my risk-based stop, which would have at the time represented a loss of my capital, and move it to a break-even. That way, if everything goes, bad on me, everything goes sour, worst case scenario, I've realized a small taste in terms of a profit, and if the trade goes against me, I have not let that winner turn into a loser. Isn't that one of the main rules? Don't let winners turn into losers. How do we define a winner? That is what starts that whole process. For me, a winner is that first profit target, which is based upon at least a 1-to-1 risk-reward ratio and acknowledging where initial support has been in the past, psychological levels, and where the bulls might step in based upon past behavior. So, again, this was gravy. This was unnecessary to my calling this trade a winner. It was very nice. It was the icing on the cake, if you will. But it was not needed to make this trade make sense. Don't put yourself in that position. So, as I mentioned, all these are like little tests. So if I'm looking at where a market might be looking forward, where a market might be going into January, February, March, April, it's not about making these large predictions. It's more about realizing that if certain support levels give way or if certain resistance levels are broken, the market can continue up or might even accelerate. Remember, it's our job as traders, especially if we're chartologists, which is what I consider myself. It's our job to identify the decision levels on a chart. Decision levels are commonly known as support and resistance, and there's a number of ways that all of us, depending upon the tools we use, identify support and resistance, whether that be different moving averages, whether that be trend lines, whether that be horizontal support and resistance, psychological levels, Fibonacci, pivots. Almost any kind of chart analysis, including indicators that would be on your subgraph, your MACDs and your CCIs, all offer some view of support and resistance. So everything boils down to, I don't care if you're an Elliott wave trader, whatever it is, everything you're doing is an effort to find where you believe the market will react. Those are decision levels. There's only 3 decisions a market can make if you've identified a decision level that's in play. It can stall, it can reverse, or it can accelerate. And if we found a price level at which we see that happening, for example, when we broke this prior low, we can see there was a little bit of acceleration. When we broke this other low, again, another acceleration. Once the bulls were not willing to support the lows they had stepped in at before, not only did they step away and no longer offer the floor, prices then accelerated because the bears took control. Those are the decisions that were being made.